Mehrab Irani is General Manager, Tata Investments at Tata Investment Corporation. Mehrab oversees almost about 10,000 crores in investments in Indian stocks. He doesn't depend on mutual fund inflows. Thankfully, Mehrab, morning you heard Ashwini. You would say thankfully?
Yeah, we can say thankfully now.
What's your sense on the market, Mehrab?
Yeah, good morning, Prashant. If you see the third quarter results of most of the companies have come, the top line or the sales growth have been close to 13%. EBITDA growth has been around 7% with a 50 basis point expansion in EBITDA margin from 20.5 to 21%. Also, the bottom line PAT growth has been close to 8% and the margin has been steady at around 10.2%. If you see valuations, as we all know, today we are not cheap. On a current year basis, we are almost 21 times price earning. On a forward basis, we are close to 17-18 times with almost an 18% expectation in earnings growth. Also, price to book value, we are around 2.9 times when the ROE is around 14.5%, which is like 100 basis point below long-term averages. So the valuations are at least like 12 to 15% premium to long-term averages. Also, if you see currently the market cap to GDP is 90%, which is again costly. Plus, if you see recently the interest rates in India have risen almost by 100 basis point over the past few months. So the bond yield minus the earnings yield have also gone up, which means that either the market is expecting the earnings to go up or the interest rates to come down, and both of that look a challenge as of now. Even if you see the expectations of earnings growth going forward, a lot of expectation is, from the global cyclical sectors, be it metals, be it oil and gas, etc., plus the PSU banks. So those also have recently got their own problems. Even if you see the global valuations today, the US Dow Jones is also trading at around 23 times, which is like a last few year high for that market also. And if you see even the fiscal deficit in the US has recently increased, it's gone to $700 billion, and analysts are predicting around $1 trillion over the next 18 to 24 months. And the US Treasury has also gone up by 80 basis points in the last few months. So this all not prove good for emerging market flows and emerging market equities as well.
Okay. Mehrab, for this year, I think what would probably be the biggest talking point domestically is politics. How big a risk do you think it is, especially going into elections?
I think a few months back it was not such a big risk, but recently what developments are happening, I think we cannot ignore it, and particularly election heavy calendar which we are going in leading to the general elections in 2019. I think we have to pay good attention to whatever political developments are happening, because I think that is a certain risk to Indian markets, because the whole if you see this bull market started from the time just before this new government came. So if that political stability were to be a little challenge going in the next few months, I think that would be another challenge for the markets.
Is it a big enough risk for you to probably rejig your portfolio, hedge your investments?
See, as of now it is not, but we have to, this is a dynamic situation and we have to keep monitoring it, and if we see any kind of negativity going forward, then I think we have to be very cautious on that front.
Mehrab, so markets, again to come back to that point, have to correct between 12 or 15%, simply put, from even these levels to get to comfortable levels?
Yeah, if you see, it has to come to long-term valuations, then either we have to correct by, as you said, 12 to 15%, or the earnings growth have to be much higher. See, today we are projecting 18 to 20% growth, but whether that will materialize or not, we don't know. And particularly the legs on which it is projected, those are also a little challenging. So I'm not sure on that.
No, this 12 to 15% expensive is based on 18 to 20% earnings growth.
Right. It is already based on around 18% growth.
That we are not really very sure.
On that also we are not. Yes, on that also we are not really very sure. So, but if the earnings growth comes, then I think it will continue to remain expensive. But if the earnings were to falter, then I think
what is your view? 18 to 20% and 90. Possible?
See, if you see, out of the delta in earnings are coming, as I said, from global cyclicals, metals, oil and gas, PSU banks, and some of these sectors have gone into little challenge over the past few weeks. So I'm not sure how much that will play out.
PSU banks obviously is the other big risk, or is it a risk? I should ask you that. And how are you approaching financials, PSU as well as private?
If you see a couple of months back, some positive news on NCLT, etc., was coming for PSU banks, and there was some kind of hope that all this will get resolved, and again the credit growth will pick up. But whatever has happened over the past few weeks on the the fraud which has happened in the banking and financial services sector, this is little worrying. Whenever any problem happens in the banking and financial services sector, then the problem is little more elongated because it affects different parts of the economy. I think next few quarters it would be a big challenge for the PSU banks to actually lend. So whatever little nascent growth which you were seeing in the infrastructure capital goods space, again that may also be a little challenge. So I would be little concerned on that front. As far as the private banks are concerned, they are obviously doing quite good. The credit growth is very good, between 15 to 25% for most of the private banks. The NIMs remain very good. NPAs are quite low. Only thing is that, a lot of the recent growth in private banks have happened through a lot of the retail lending and the unsecured book lending. So as of now, there is no problem, but how this cycle plays out over the next 18 to 24 months, that we have to see. But yes, private banks overall are looking quite good. Valuation is slightly extended.
Typically, Mehrab, in the AUM that you manage, what is the proportion of exposure to mid-caps? Historically, the proportion to mid-cap is keep varying. So as of now, more and more people that I speak to, they say that we are now overwhelmingly into large caps. I mean, that may be to limit exposure, risk, etc.
Yeah, I think that is true for most of the market players.
I mean, so you are now overwhelmingly in large caps.
I would not say that way, but yes, we would remain slightly cautious on the market at this point.
How are you approaching IT stocks? Outperforming this year? Are you bullish? Are you increasing your weightage?
Yeah, if you see IT stock after a long time, over the past few months have actually outperformed. Today the valuation of the IT sector is around 18.5 times. So after this outperformance, that is also trading at 15% premium. But I am still not sure about a lot of the large cap IT stocks. I hope it is not a value trap. So, but the mid cap IT sector, a lot of stocks are looking quite good. So selectively, yes, I think we should increase exposure in IT stock, particularly in the mid cap space.
Could you rate in terms of allocation top, say, 3 sectors?
Yeah, I think, as I said, private banks would remain one of the top sectors.
Yes.
I think autos also continue to do quite good. The numbers in the passenger vehicles, the two-wheelers, etc., the numbers are quite good and they are encouraging. So I think that remains. No doubt the valuation is very high.
Sure.
Like the top passenger vehicle in India, companies quoting at 50% premium to its own historical valuation. So the valuations are quite challenging over there, but the growth continues to remain over there. So there I will remain positive. Also, if you see the consumer, the FMCG space, that is also doing quite good. Again, the valuation over there is at least at a 30% premium to long-term averages of that own sector. But still, if you see the volume growth is again coming back to the consumer space. The channels are also improving, the wholesale and the retail channel, both after the demonetization and GST disruption over the past few quarters. They are now again trying to stabilize. Plus the cost inflation which that sector was seeing, I think that is now again receding from this quarter. So I think the earnings in that sector should be in line or beat expectations. So though they are costly, we would continue to remain positive.
So in that sense, actually not very much has changed, right? I mean, not just for you, but for the industry as such.
Yeah, I think
it always was private banks, consumer staples, and
yeah, I think that same thing is what was people are liking, the positive news are coming on that, and what people are not liking or underweight, continued negative news are coming on that, like PSU banks and etc.
All right, a pleasure speaking with you, Mehrab. We're going to wrap it up on that note. Thanks very much for joining in and talking to us. So that is